If you're new here, I'm Paula. This channel isn't about reacting to headlines or predicting short-term moves. It's about understanding how the world actually works, especially in periods where the markets behave in ways that feel confusing or disconnected from the news. This video is part of a longer series where we're stepping back and looking at what's changed beneath the surface in money, power and markets, and why the usual explanations don't really hold up anymore. In the first episode, we talked about why nothing really gets resolved anymore, how systems manage problems instead of resetting them. In the second, we looked at what happens once a system starts managing limits and why money quietly stops being neutral. In the third, we explored why once money becomes strategic, the form it takes suddenly matters. This episode is built on all of that. Because once money is strategic and the form of money matters, there's one thing that quietly sits underneath everything else: liquidity. And if you want to understand why volatility keeps appearing where it does, and why Japan keeps coming up in conversations that seem unrelated, this is where it starts to make sense. Liquidity is one of those words that gets used constantly but rarely explained properly. People talk about too much liquidity or liquidity drying up as if it's some kind of abstract force. But liquidity is actually very simple. It's the ease with which money can move. Not how much money exists in theory, but how easily it can be accessed, deployed and withdrawn without causing disruption. And in a constrained system, liquidity becomes far more important than price. In a world driven by growth, liquidity is almost invisible. Money flows freely, credit expands, assets reprice smoothly. But once systems are managing limits instead of expanding capacity, liquidity becomes uneven. It doesn't disappear all at once, it moves. And where it moves from and where it gets moved to matters a great deal. This is why markets can feel calm one moment and suddenly volatile the next. Volatility isn't always a reaction to bad news. Very often it's a reaction to liquidity shifting. When liquidity is abundant, risk feels manageable. When liquidity tightens, risk feels exposed. Not because the fundamentals changed overnight, but because the ability to absorb shocks changed. At this point, it's worth asking a simple question. If liquidity matters this much, where does it actually come from? Because liquidity doesn't just exist on its own. It's created, released and withdrawn by a small number of forces. The first source is central banks. When central banks cut rates aggressively, expand balance sheets or step in with emergency facilities, they make money easier to access. That doesn't always show up as cash in people's pockets, but it shows up as confidence in markets. Risk feels absorbable, leverage feels manageable, liquidity feels abundant. The second source is the banking system itself. Banks create liquidity when they lend. When lending is easy, money circulates. When lending tightens, liquidity quietly disappears. Not because money vanishes, but because it stops moving. And in a constrained environment, banks become more selective, not ideological, practical. The third source is global funding flows. This is where places like Japan come in. When money is cheap somewhere, it gets borrowed and deployed elsewhere. That borrowing is liquidity. And when conditions change, when rates shift or risk tolerance drops, that flow reverses. Liquidity doesn't evaporate, it goes home. And when it does, markets feel it immediately. Those three forces, central banks, banks and global funding, are constantly interacting. Sometimes they reinforce each other, sometimes they cancel each other out, but they're always there. And once you understand that, liquidity stops feeling mysterious, it becomes directional. This is where Japan quietly enters the picture more clearly. Japan is rarely the cause of market stress, it's the pressure point. For decades, Japan has operated with extremely low interest rates. That made the yen cheap to borrow, and when money is cheap to borrow, it gets used. Not necessarily in Japan, but everywhere else. Borrow yen, deploy capital globally, earn yield elsewhere. This becomes one of the most important sources of global liquidity. As long as that system runs smoothly, nobody really notices it. But when conditions change, when rates shift, expectations shift, or risk tolerance shifts, that flow starts to reverse. And when it reverses, it doesn't reverse gently. Positions get unwound, exposure gets reduced, liquidity gets pulled back. And suddenly markets that seem unrelated start moving together, not because of a shared story, but because they were sharing a funding source. This is why Japan keeps appearing in headlines during periods of volatility. Not because Japan is destabilising the world, but because changes there affect how easily liquidity flows elsewhere. When funding becomes more expensive or less predictable, leverage comes down. And when leverage comes down, volatility goes up. This is also why volatility often shows up before explanation arrives. Liquidity shifts faster than narratives. By the time a story appears on the news, positions have already been adjusted. The headline doesn't cause the move, it arrives after it. In a constrained system, liquidity is constantly being rebalanced. Central banks aren't just setting rates, they're managing stress, trying to keep markets functioning, trying to prevent disorderly moves, trying to avoid sudden freezes. This is why policy often feels reactive rather than decisive, because the goal isn't optimization, it's containment. This also explains why some markets feel strangely resilient while others feel fragile. Liquidity doesn't draw evenly. It leaves areas where risk feels less dependable and concentrates where support is more likely. This isn't about fairness, it's about survivability. And this brings us back to something important from earlier episodes. In a system that can't reset, volatility doesn't disappear, it relocates. It shows up where liquidity is thin, where leverage is high, where funding is uncertain, not necessarily where the news is loudest. This is why trying to trade headlines becomes so dangerous in this environment. The story you're reacting to is often not the driver. The driver is what's happening underneath in funding, liquidity, and positioning. That's also why markets can feel cruel. They move before explanations feel available. And by the time the narrative settles, the opportunity or the damage is already done. Understanding liquidity doesn't make the markets predictable, but it does make them legible. You stop asking, why did the headline cause this move? And you start asking, what just changed in funding or risk tolerance? That's a very different way to see the world. This is also why Japan, liquidity, crypto, equities, bonds, all of it ends up connected. Not because they share fundamentals, but because they share capital, and capital moves according to conditions, not stories. Once you see all of this, a lot of confusion starts to lift. Why markets sell off on good news? Why volatility spikes without warning? Why calm periods suddenly end? It's not randomness, it's rebalancing. This episode isn't about predicting when liquidity will tighten or loosen. It's about understanding why volatility appears where it does and why some parts of the system feel permanently on edge. Because once liquidity becomes the primary stabilizer, everything depends on its availability. In the next episode, we're going to bring this all together. We'll talk about what this environment actually rewards and what it quietly punishes, not in terms of moral judgment, but in terms of behaviour. Because every system rewards certain actions and discourages others. And understanding that might be the most practical insight of all. If this way of thinking resonates with you, make sure you're subscribed. This series is designed to build layer by layer, and each episode adds context that makes the next one clearer. If you found this useful, a like genuinely helps push this content out to more people. Content built for understanding, not reaction. Now, understanding the world is one thing, knowing how to operate inside it is another. That's why we've made a completely free course called the Crypto Liftoff course, where we break down the exact strategies we use to make money in both the bull market and the bear market, without chasing headlines or emotion. The link is in the description below. Thank you so much for watching this. Take your time with it, and I will see you in tomorrow's video for the final part of our series.